For years ago, Synthetix was DeFi royalty. Then the multichain craze scattered its liquidity, and a brutal bear market trapped the token inside a falling-wedge prison. Fast forward to now. The protocol shutters every sidechain vault, drags traders back to Ethereum Mainnet, and dangles a headline-grabbing 51% APY for anyone willing to stake fresh SNX. Meanwhile, the first Layer 1 custody Perps exchange is already live. On-chain flows have flipped violently green for Ethereum, and my chart shows 5 clean take-profit rungs stretching all the way to $8 territory. The real question isn't whether Synthetix can come back, it's whether you'll be positioned before the wedge detonates. Stick around. In the next 9 minutes, you'll get the migration deadlines, the staking math, and the one invalidation line that lets you sleep at night. For 2 long years, Synthetix felt like yesterday's news, fragmented across optimism, arbitrum, even base, with fees slipping and traders chasing shinier Perps venues. Then a single data viz changed the narrative. Ethereum Mainnet has pulled in almost $3 billion of net inflows over the last quarter, while every major L2 is bleeding red. The Spartan Council read the scoreboard and went all in on Ethereum. By collapsing spread-out liquidity back to Layer 1, they regained the deep order books that once made the platform famous. When a 2018-era protocol voluntarily exits the Layer 2 gold rush to reclaim L1 security, that's not nostalgia, it's a bet that real-yield traders still value finality over gimmicks. Suddenly, legacy looks more like leverage. The comeback hinges on a fresh Perps decentralized exchange designed for block-native custody, but centralized exchange-like execution. Order matching now lives in a high-performance engine on Layer 1, eliminating bridge risk while keeping fills snappy enough for scalpers. To grease the wheels, Synthetix launched a points campaign, exclusive invite codes, and gated trading competitions where prizes are paid in SNX and stablecoins. That combo attracts whales hunting prestige, degenerates hunting multipliers, and builders hunting reliable liquidity. The more volume that flows through this engine, the larger the fee stream sent to stackers, which in turn locks up more SNX, tightening supply. It's a positive feedback loop, wearing a very slick UI. Now for the pressure cooker. Arbitrum vaults are already in close-only mode with full deprecation just months away. Base Perps shut down on July 7th. Users have 6 months to claim collateral or the debt becomes protocol property. Deadlines do 2 things. They scare tourists and galvanize believers. Anyone holding SUSD, or leverage synths must choose. Sell and leave for good, or migrate to mainnet and farm points plus triple-digit incentives. History shows most users follow the yield. Forced movement also means transaction bursts, higher gas visibility, and big spikes in staking total value locked. Deadlines are not just housekeeping. They're marketing events hiding in plain sight. Enter the 420 pool, the freshly revamped staking contract born from SIP 420. On screen, you can see more than 170 million SNX already locked, with 51% annualized returns on new deposits and roughly 39% for SUSD. That yield isn't funny money inflation. Protocol-operated yield routes Perps fees, Aave integrations, and other DeFi revenues straight into staking providers' pockets. A total value lock chart beside the pool rockets upward for March, confirming fresh demand rather than zombie tokens. When you combine sky-high APR with upcoming collateral migrations, you create a gravitational pull strong enough to yank idle SNX out of dusty wallets, and even lure new capital from yield-starved stablecoin holders. Scroll down the homepage, and you'll hit a wall of partner logos. Chainlink, Coinbase, Peeth, Wormhole, Optimism, the kind of brands that light up pitch decks. But they are not trophies, they're plug-and-play modules. Synthetix now offers an SDK that lets any dev launch a derivatives app in days. Want multi-collateral perps? One click. Need Oracle feeds? Already wired. The model morphs Synthetix from one exchange into Liquidity-as-a-Service, where every new builder deepens fee generation without fragmenting order flow. More products beget more trades beget more yield. More yield begets more SNX staked. That's a flywheel no marketing budget can imitate. Zoom into the 2-week chart. SNX has ping-ponged inside a monster wedge since August 2020, each relief rally tapping the upper rail, each capitulation cushioned by the lower. At 50-some cents, buyers finally drew a line in the sand. The visible range volume indicator shows us fatter bars right here where price is. That screams accumulation. Normally, when the Heikinashi RSI indicator is below -20, the asset is considered extremely oversold. So with the price being in a region of support, plus these two indicators pointing to an accumulation zone, the risk-return ratio becomes very attractive. A weekly close above 90 cents tears the roof clean off and ignites a Fibonacci staircase. 120, $2, 370, 560, and the jackpot at $8.88. Violate 39 cents on a weekly close and the thesis dies quickly. No drama, no heroic bag holding. Manage risk and harvest upside. That's simple. Here's my own playbook. I'm nibbling with a 2% account allocation at current prices, stop just below the invalidation line. If we break and retest the wedge ceiling, I'll layer in another % and ride momentum. Trimming is not optional. I'll peel 10% at the first fib level, 15 at the second, and so on. The goal isn't to nail the top, but to compound capital while the chart behaves. Emotional hacks help. I name each take profit after something tangible. New laptop, gym membership, family dinner, big fatty, you choose it, my friend. So locking gains feels like winning, not missing out. Markets reward discipline, not bravado. Let greed pay the bar tab, but let rules keep the house. Patterns break out faster when fundamentals pour gasoline. The new mainnet exchange is already clocking tens of millions in weekly volume across 90 markets without paid promos. Scale that by even a modest ad push and fee revenue could explode. End-of-month vault migrations will funnel every synthetic asset holder back to L1, just in time to chase those 50+% yields. Meanwhile, developers are queuing up. The SDK shrinks derivative app launch times from months to days. So expect option vaults, copy trading overlays, and maybe real-world asset synths before year-end. Each product routes fees to the same staking contract, amplifying yields and tightening token supply. Catalysts are not distant promises. They're lined up like dominoes. Once one tips, the momentum becomes very hard to stop. So, what am I doing? First, farming that 51% yield in the 420 pool while price coils. Second, placing staggered limit buys down to 50 cents, right inside the fat volume node. So, market wobbles become discounts, not deterrents. Third, tracking fee-to-emission ratios every Friday. If real revenue outpaces token rewards, the yield is sustainable rather than subsidized hype. Want to replicate that framework without drowning in Discord scrolls? Check out DeFi Financial Freedom, the ultimate beginner's guide. It walks through platform selection, safe staking, yield farming, and clever airdrop strategies using names you already know. Uniswap, Aave, Velodrome, Aerodrome, etc. $5, cheaper than your latte on Starbucks? And the link sits in the pinned comment whenever you're ready to turn curiosity into long-term cash flow. Synthetix was dismissed as yesterday's hero, yet the data, the yields, and the chart all whisper the same phrase. Second acts can be bigger than the first. Whether this becomes a face-melting rally or just a tidy double, the risk to reward is skewed heavily in favor of disciplined optimists. If today's deep dive brought you value, smash that like so YouTube knows we're cooking. Drop your personal first take profit level in the comments and let's compare notes. Oh, and hit subscribe so you don't miss tomorrow's episode on another breakout setup. End screen videos are popping now. Tap it and keep the alpha flowing. See you on chain.